Hello, everyone. This is Charles Weeks, the founder of Barrister, with the latest Barrister Brief. Today, we're going to touch on three different subjects. The first, inflation and loss of purchasing power. The second, while some stocks that perform well today may not be the same stocks that perform well tomorrow. And then finally, active versus passive management. So the first subject, loss of purchasing power over time. I'm going to pull up a chart. This shows over the past 30 years, the performance of the S&P 500, which is the largest 500 companies in the United States measured by market capitalization, which is share price times share outstanding, versus U.S. Consumer Price Index purchasing power over that same 30-year time period. And what's really amazing and scary at the same time is that over the past 30 years, $1 is now worth less than 50% of what it was worth 30 years ago. If you would have taken that same dollar and invested it in the S&P 500, you'd have had an 840.5% return over that time horizon. Now, while we understand that you're not going to take every dollar that you have and invest it in the S&P 500, what this shows you, though, is how important it is to have your dollars grow for you over time. I like to tell the story and make the joke about my grandfather thought that the best use of his dollars to save was to wrap them in plastic and put them in the freezer. And he thought he was protecting his dollars. But you can see he really wasn't protecting his dollars. Over a 30-year time period, his dollars were losing over 50% of its purchasing power. So he was really slowly losing money over time. It's easy in today's kind of interest rate environment that we're in to fall in love with a money market fund paying 5%. And it's a great return for cash, but it's not, necessarily the best return for the next 10, 20, 30 years. Again, a diversified portfolio where you have some stocks, bonds, real estate, commodities, and cash likely will perform better over the next 10, 20, 30 years than what you can get on the money market account today. But again, I think this is just a really strong visual to show you how important it is to do something with your dollars. You can't leave them in cash. You can't just leave them in a checking account or a savings account earning, very little interest unless it's a high yield checking or savings account where you might get 4 or 5%. You have to do something to make your dollars work for you. If not, they're just simply losing purchasing power over time. The next chart I want to show is the top 5 companies in the S&P 500 by market cap through the previous decades. You can see the 80s, the 90s, the 2000s, and on. What companies were the top 5? Now, there's some, companies that did repeat, at least through a couple of the decades. IBM, for example, in the 80s and 90s, Apple in 2010 and 2020. But there's also some companies that popped up and then totally disappeared. The reason I'm talking about this is because of all the excitement and the really crazy performance from some companies like NVIDIA out there with AI, and even not just NVIDIA, just the Magnificent Seven stocks in general. Meta, Apple, Alphabet, all those companies. They look great now, and they performed very well over the recent time period. But will they be the same companies that are in the top, that are the top 5? In the 2030s, the 2040s, the 2050s. I don't know, and no one knows, and that's why diversification is so important. And it really gets back into the idea of a diversified portfolio of investments versus taking a large sum of money and making a concentrated bet on just one company. Any one of these companies, that popped up in the top 5 previously, or ones that will be in the top 5 in the future, they could all potentially go to zero. Right? An individual company could lose, you could lose your entire investment if it's just in one company. That won't necessarily happen in a diversified portfolio of index mutual funds or ETFs, where you're really owning everything in the market. If that went to zero, we really wouldn't be worried about our money anymore. There'd be, much greater, much worse things going on. Finally, I want to show you one more slide here. This is the SPIVA US scorecard. Every year, there's a study done on active versus passive management. And again, active meaning that the managers are hired to outperform whatever index they're compared to. So if you are managing a large cap mutual fund, you are going to compare your performance year to year to the S&P 500. That's the large cap index. And it's really, really interesting to compare those active managers to the indexes themselves and to see, can they actually outperform those indexes? Because if evidence tells us they can't, which it clearly shows within this study, then you should not pay extra fees to have a mutual fund manage your investments for you. You should really invest in exchange traded funds, diversified portfolio of low cost ETFs, or again, index mutual funds, and just capture what performance you can. Don't try to outperform. And if you can get 8 to 10% or 6 to 8% or 4 to 6, whatever your investment goal is based on your time horizon and your risk tolerance, then that's really the way to go. So if you just take a second and review this with me, you'll see over the past 20 years, if we just look at large cap managers, over a 20-year time horizon, 96% of them failed to outperform their index. 96%. I mean, just a huge number. And you can just drop down and look at all the different large cap, mid cap, small cap, multi-cap growth, real estate funds over long-term periods, 20-year periods. Most of them have failed to outperform their index. If we look at small cap value, that's it, 84%. That's the best we can do. 84%, meaning that only 16% of them could outperform. To try to find those 16% that outperformed, it's going to be really difficult. And what you'll find is years where some managers tend to outperform, then years after that, they tend to underperform. So you end up chasing manager performance. And the ones that do tend to outperform over long-term periods, 10, 15, 20, 30 years, there's going to be times during that time period that they underperform. That's how they get their outperformance versus the index. They are not investing in the same way the index does. So it would be rational to assume that, well, if they're not doing exactly what the index is doing, they're going to have some, time periods where they skew away from index performance. Most investors cannot live through those years that they're underperforming the index to be able to capture the years that they outperform the index. So it's just human nature. As soon as the manager starts to underperform, we dump them and we jump somewhere else, or dump her and go somewhere else. Again, we're never going to capture the outperformance. So just from an investment philosophy standpoint, that's why at Barrister, we use exchange traded funds, put together diversified portfolios of these ETFs, matching clients' risk tolerance to their time horizon, and invest accordingly. That's it for this Barrister brief. If you have any questions, as always, feel free to reach out to the firm. You can get our contact information at our firm's website, www.barrister.net. Take care.